Welcome to the Mortgage Foundations podcast, where we are here to guide you through the ins and outs of the mortgage world. Get ready to unravel the complexities and gain a solid understanding of everything you need to know about mortgages. Whether you're a first-time homebuyer or a seasoned homeowner, we've got you covered with expert insights and tips. Let's dive into the fascinating world of mortgages together. In today's episode, Tyler Cowell, the principal broker of Mortgage Foundations, FSRA number 13614, will explain what a home equity line of credit is and how it can assist with your financial goals.
A home equity line of credit, or HELOC as it is commonly referred to, is a method of tapping into your home's equity, much like a mortgage refinance or second mortgage, except there are some key differences between them. A HELOC is a type of mortgage that is still secured by the property, however works more like a credit card than a normal mortgage. A HELOC allows a client to draw funds as required instead of a normal mortgage that is commonly one lump sum at the start. A HELOC is a type of re-advanceable loan or revolving loan. The flexibility of a HELOC is one of the main benefits of the product since you are accessing funds as they are required, and therefore you will only incur interest costs on funds you actually use, not the full limit available. This can be particularly useful for home renovations, unexpected expenses, or other significant financial needs that may arise. Sometimes it is better to have access to funds as needed, rather than just have a large sum of money in an account. Another benefit of a HELOC is that they can be paid back at any time without penalties. This is different from most regular mortgages, where you are only able to pay back the full balance at the end of the term. Otherwise, you may incur a prepayment penalty, which can be substantial. With a HELOC, you can make as small or as large of a payment as you want, as long as you are covering the minimum amount required by the lender. The minimum payment is normally the monthly interest plus an amount required to pay off some of the principal. Every lender is different in how they structure their minimum payments, and it is important to know how your lender does. A further benefit of a HELOC can also be viewed as a drawback at the same time. Unlike many other types of revolving loans, such as credit cards and standard lines of credit that feature high interest rates on balances, a HELOC features fairly low interest rates. However, these rates are normally higher than the interest rate on a regular mortgage, and a HELOC's interest rates are variable, not fixed. Since they are variable, fluctuations in the lender's prime rate will affect the amount of interest that is charged, and the ability to cover even just the interest costs may be affected in a rising rate environment. As an example, if we look at a HELOC when prime rates were historically low in 2020 and 2021 versus when prime rates peaked in 2023, we can see a drastic difference in the interest cost incurred on a HELOC. The common rate of interest on a HELOC is prime plus 0.5% or a full percent. For the purpose of our example, we will use prime plus 0.5% and a HELOC balance of $250,000. When prime was at its lowest, the interest rate on the HELOC would have been 2.95%, and the monthly interest costs would have been roughly $614. That same HELOC would have featured a rate of 7.7% in 2023, and the monthly interest cost would have been $1,604, or almost $1,000 more per month. Many people drew large amounts from their HELOCs when rates were low for things like investments, renovations, or a down payment on a second home or investment property, and may have been unprepared and affected negatively when the prime rate started rising. Since a HELOC is secured by the home just like a regular mortgage, failure to repay could result in a foreclosure or power of sale of the property. It is important to discuss your financial needs and plans with a mortgage broker in order to ensure you have the proper product in place for your future needs. If your HELOC may be drawn to its limit for an extended period, it may be better to look at a regular mortgage instead. Everybody's situation is different, and there is no one-size-fits-all HELOC or mortgage. It is important to note that just like a standard line of credit, which is not secured by property, a HELOC is a demand loan, which means that the lender can demand repayment at any time or even adjust the interest rate or limit whenever they would like. If the lender sees that a client is potentially at risk of not being able to cover their expenses, they may look to limit their exposure to loss just in case. This is different from a regular mortgage, where the lender cannot make changes during the term. In conclusion, A HELOC is a great product and an option to take out equity from your home with many benefits. However, it is very important to discuss all options with a mortgage broker and weigh the benefits against the potential risks before taking out a HELOC. Considering all aspects of a HELOC and ensuring that a solid repayment plan is in place is imperative to financial health.
In today's episode, we explained what a home equity line of credit is and discussed the benefits and potential drawbacks of this type of product to use equity in your property. Thank you for tuning in to Mortgage Foundations, and remember, every home starts with a foundation. Your mortgage should too.